Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A episode, and the first question is from Amanda. I'm going to paraphrase Amanda's situation. Essentially, Amanda's saying they're in the fortunate position where her in-laws considering giving them investment property in a suburb that they would like to live in for their forever home. Amanda's married, got 2 children, 4 and 2, and might have a third. The property that they might receive as a gift has a dwelling on it, of course, but it's in pretty ordinary condition, and they would like to demolish that and build their forever family home. And they think they could build one with an extra bedroom so that if the in-laws need to move in the future and they need to look after them, they can do so. And so they will need to borrow to do the construction. And Amanda's asked, what are the considerations? What are the costs? All those sorts of things to sort of think about. And, I've said it before, but I guess it's funny with Q&A sort of episodes is that it brings up these small little kind of micro considerations that aren't enough in of themselves to be a full episode, a full Wednesday episode, but are still interesting and important. And I've also said that it gives me an opportunity to share my experiences as well, because, whilst these things don't happen that often, they do happen, and you can kind of, share some of the pros and cons that we've experienced of people in similar situations. So that's why I like the Q&A. I guess that's why people like to listen to the Q&A. Hopefully you do as well. So anyway, okay, Amanda, let's talk about your situation. So I have a client that owns a proportion of his home that he occupies with his wife, and his mum owns the other proportion of the property. I think he owns like 20%, she owns 80%, something like that. And he is the sole beneficiary of his mum's will, no other siblings, and he will inherit the home eventually. So it hasn't transferred to him yet because she's still alive, of course, but the whole idea is that, just leave the transfer for it to come through via the will, because then you avoid stamp duty and you get to avoid paying the capital gains tax as well. The estate will have a capital gains tax liability, and my client will inherit the unrealized capital gains tax liability, but doesn't have to pay it until he sells the property. So you kind of kick the can down the road. It's been a massive pain in the neck, the arrangement, because it really stops my client from borrowing against the asset. And the reason it stops borrowing against the asset is because all people on title need to be party to a loan, either as an applicant or guarantor. And banks don't really like taking guarantees from retiree parents, because they don't want to end up, if the loan goes bad and they've got to act on the guarantee, they don't want to end up on a current affair looking like the big old bad bank, taking advantage of or selling a elderly person's home, albeit not their home that they're occupying, but at least a property nonetheless. So that's why it's been a pain in the neck, because we can't use the equity in the home to build wealth, and that's typically a key strategy for most people. Amanda didn't tell me how mid-30s. Amanda's in the mid-30s, so that's in consideration, right? Just means that, well, until the property's in your full name, you're not going to be able to realize or utilize the equity, and that's going to be challenging. Notwithstanding that, it's going to be challenging to borrow to fund the construction as well. So, look, I think you're probably just better off biting the bullet and your in-laws transferring the property into your name. They will need to pay stamp duty and they will need to pay capital gains tax. So you need to consider what those numbers look like and how are they going to pay it, assuming, if they've got the cash to pay that. Or you might, as the recipient, pick up the bill for those transactional costs. I don't know. That's up to you guys. But if it is transferred into your name, then you've got full use and benefit of the property, both in terms of borrowing to fund the construction and then also potentially utilizing the equity in the future, borrow to buy an investment property or do whatever you want to do. Again, that just sort of depends on your plans. If you're just focusing on the capital gains tax and stamp duty consequences, well, the best way for the property transfer to you is via a will. So they could just write a will to say this particular asset will go to Amanda and her husband or partner. And if it transfers via a will, you inherit the cost base. Like my client, you just kick the can down the road. You'll have to pay it one day when you sell the asset, but not immediately. And you're not going to pay any stamp duties. So certainly in the long run, that would be the best way to do it. But in the short run, I think having consideration to all the costs and opportunity costs and flexibility, all those sorts of things. I think transferring the assets and paying the stamp duty and capital gains tax probably the way to go, but it just depends on the size of that, the quantum of those costs, and if you're in a position to actually fund them. Great question, Amanda, and good luck with it all. Okay, next question is from Josh. I've been an avid listener of your podcast the last 4 years, so that's good. Almost from the start. Maybe it's not the start, actually. I can't remember where I started. Anyway, shouldn't get sidetracked. Thank you for incredible wisdom and practical advice you continue to share. It's been a real source of clarity in navigating financial decisions. You're most welcome, Josh. It's a lovely bit of feedback. I appreciate you enjoy it. I've got a burning question I'd love your insight on, I should say. I'm currently 39, married with 3 young children, 9, 8 and 5, and hold income protection policy with AIA, which I took out back in 2018. As I understand it, it's one of the older agreed value policies that are no longer available on the market. The policy includes the following add-ons: claim escalation option, plus option, and split income protection structure. As the premiums continue to rise significantly each year, I'm trying to assess whether any of these add-ons could or should be removed to manage cost without compromising on the core value of the cover. Could you please share your thoughts on this, if any, of the options that might be less essential and how best to evaluate them? Really appreciate the insights. Okay, so I really like this question because it's about insurance, and we don't get a lot of questions about insurance. I guess it's not a sexy topic, of course, but it's a really important one. And it's really hard to navigate the insurance market in terms of understanding what cover do you need or should you have, when to reduce that level of cover, how much to spend on insurance, like how much is too much. All these sorts of, and they're really important considerations. And I guess the other challenge to throw into the mix is that, if you go and speak to an insurance advisor, most of them are sort of commission based. And so you've got that sort of conflict of interest to deal with as well. So that's why I like the option or the opportunity, I should say, of sharing some information about this. So there's a bit to unpack here, and I hope I don't bore you to death, but it's really important if you do have insurances. I would say income protection insurance, not for everyone, but for a lot of people, is probably the most important. And remember, income protection covers you for if you have an accident or an illness and you can't work in your full capacity, and it'll pay you a monthly benefit through to age 65 or 70, depending on the policy. And it doesn't pay out for unemployment. So if you lose your job, it doesn't cover you that, but it covers accident and illness. I just want to mention that because it's often a misconception there. You can have 2 types of policies: agreed value and indemnity value. Agreed value means that they do the underwriting of the benefit when you first apply for the insurance. So you can insure, say, $10,000 a month of income. And if you've got an agreed value policy and then have an accident 2 or 3 years later, and before the accident, or in fact 2 or 3 years before the accident, you weren't earning any income, doesn't matter. They still have to pay you the $10,000. And the challenge with that for the insurance industry, or was for the insurance industry, is that if I haven't been working for the last couple of years, for whatever reason, then I have an accident and now the insurer is going to pay me $10,000 a month. There's no incentive for me to come off the claim. Like, why would I return to work if I wasn't working in the first place? And that's what caused problems for the insurance companies with the agreed value, because they end up having people on prolonged claims without any incentive for them to go back to work. So they've got rid of agreed value. Now it's indemnity value. And what they will look at typically is the highest year of income over the last 2 or 3 years. So they will take the highest over the last 2 or 3, typically. It's different for every policy, right? But essentially it means that if you weren't working for the last couple of years and you have an accident, then you're not going to get a benefit. So in that situation, if you've got indemnity value income protection and you're not working anymore, you've got to think really carefully about whether you keep that cover going. If you plan to return to work, you might. If you never plan to return to work, of course, you get rid of it. So Josh has got agreed value, which is great, but it can come at an extra cost. And what the insurance companies are trying to do is get rid of all these old legacy policies because they're costing too much money, because Josh can go on claim in 3 years' time, even if he hasn't worked for the last 3 years. And that's a problem for them. So I think what they're going to do is keep increasing premiums for agreed value policies, try and incentivize their clients to move on to these newer style policies. Now, is agreed value any benefit to Josh? Well, I don't know, because I don't know his situation, but agreed value is a good policy characteristic if you've got a client where their income can be very volatile from year to year, where there's a lot of volatility. And I was going to say self-employed people, sometimes maybe contractors, probably more commonly. But I find even with self-employed people that their income tends to be relatively consistent from year to year. And certainly if you're PAYG employee, unless you've got a high variable component in your remuneration, you probably don't need agreed value. So that's the first thing I would think about, Josh, is whether you should give up agreed value, go with indemnity. And here's the thing that insurance always plays on is loss aversion. So that's the whole thing, right? You've got this product, we can't sell it anymore. It's so good, don't ever get rid of it. There's got this sort of loss aversion principle that they all work to. It's something whether you want to consider that. Okay, let's talk about the different options or add-ons Josh has got. Claim escalation option, often called indexing. So what that means is, and a lot of insurers offer it, and it is typically a standard option that would be included in products. And it's important, right? Because if you are, say, early 30s and you go on claim and you can't work for the next 30 years, well, if your benefit is an index to CPI, in 30 years' time, you're going to be destitute. You're not going to be able to actually afford to live. But as you get older, indexation starts to become less important. So Josh is 39. Let's say policy pays through to age 65. That's 25 years. It probably still is necessary to have CPI on that benefit. But in 10 years' time, for example, probably not. So that's what I'd think about in terms of indexation. So AIA calls it claim escalation option, but whatever's indexing to CPI. The plus option, I don't know what that is, and it's going to be different they've got different policies, right? So it's really, and they'll rewrite those policies every 2 or 3 years. So they're all very different. So I can't sit here and tell you what that includes. But quite often, we are not interested in the bells and whistles. And insurance companies will go out of the particularly personal income protection or personal protection insurances like life, TPD, income protection, trauma. They'll go out of their way to put on all these bells and whistles to try and add or try and prove value or demonstrate why you should pay a higher premium. At the end of the day, what we want to do is if you can't get out, if you're financial position is such that it's premised or dependent on you being able to get out of bed, go to work and earn an income to pay for living expenses, to be able to save for retirement, then we should insure that risk. It probably makes sense to insure that risk for most people. That's all we want is replacement income. Whether there's an additional rehabilitation benefit or additional benefit if your child has an issue or these sorts of things, that's not what we're looking to secure. So, Josh, I wouldn't be influenced very much by all the options and the bells and whistles. And finally, the third option that Josh has is a split IP structure. Essentially, that means that most of the premium is paid from super and some of the premium is paid from personal names. That's fine. It's more tax effective to pay the whole premium from your personal name. So Josh, if you can afford to do that from a personal cash flow perspective, that's a much better option because therefore you'll get a tax deduction on the whole premium. And so your after tax cost is much lower. You'll still get a tax deduction inside super, but only at 15%. So Josh, if you're a higher income earner, you better have the income protection policy not split, but in your personal name and get the full tax deduction for it. I'd turn off all the plus options, most likely. This is not advice, of course. This is just, information. Do your research, understand what they include, but I would turn them off and I'd probably, consider the risk in terms of your predictability and variability of your income, but I'd probably think about turning indemnity value off and I'd probably keep claims escalation. So I'd probably keep CPI. So what I'd do is I'd go to the insurer and I'd say, give me a quote for get rid of the split policy, just have it 100% in my name, get rid of the plus option and go to indemnity value and run me a quote and tell me how much I'm going to save. And then what you can do is then weigh up what is the cost and what's the benefit. And if you're going to halve your premium, you're probably not. But if you're going to halve your premium, then it's a no-brainer, probably. But if you're saving $5 a month, you're probably not going to bother with it too much. The next one to go would be the claims escalation. But I think maybe in the future, particularly as you've got young kids, if you do have long-term incapacity, and it's rare, like the amount of claims that go longer than 5 years is relatively small. I can't remember numbers, something like 10, 15% or something. So, it's a low risk, but it's a severe one. So if you have a car accident and you're out of work for the next 15 years or forever, that's a huge impact on your family. So you need to insure that risk, particularly if you're the sole income earner. So you want that basic level of cover in place, but the bells and whistles you don't really need to use. So I thought I would expand on my answer to that question because it's a really interesting situation, insurance. You've got a cohort in the financial services market that just wants to sell, you as almost as much insurance as you're willing to buy. But I think with, we all know insurance premiums for everything, for car, home, for personal insurances have increased so much over the last 5 years. We're all forced into the situation of, making compromises and working out what's acceptable and not acceptable in our situation. And income protection, trauma, life, TPD, they're all the same in terms of, we're all going to make these trade-offs, I guess. So I thought it was an interesting one. Maybe it should be a separate episode, but it is a pretty dry subject and most people don't really want to hear about it. But thanks so much for your question, Josh, and hopefully that's been useful for you. And thanks for listening for the last 4 years too. Okay, next question is from Mark. Mark provides some very lovely feedback about the podcast. So thank you very much there, Mark. But I'm going to just sort of summarize Mark's condition. It's really one of those questions of, where to from here given my current situation. And he's wondering whether to sell and upgrade his home, whether to renovate his home, and what else to do with his asset base. Mark's 40, his wife's 42. Mark earns $430 plus super, including super. Wife earns $60 including super. 2 kids, 10 and 5 years old. Mark owns 3 properties. His home that's worth 1.8 with a loan balance of 270. So really not a lot of non-tax-deductible home loan debt. He's got an investment property in Melbourne that's worth 730 and has a loan balance of 480. He's got another investment property in Brisbane, well, north of Brisbane, really. It's worth 830 and has a loan of 530. Some managed funds, well, I'm not aware of these. A couple of managed funds, say 110,000. I'm not really aware of either of them. They're certainly not low-cost ETFs, are they, Mark? So I don't know. Anyway, 15 grand of crypto, 210 in the offset account. So really ostensibly only about 60,000 of home loan debt and about 580 in combined super. So, Mark and his wife are in a really great financial position, which is good because he'd like to be in 20 years' time, would like to have a perpetual portfolio. And so for those that haven't listened to the podcast for a while, perpetual portfolio is one that will continue to grow in value despite, being in retirement and spending some of the income and capital growth. Well, for that to happen, you're spending less than the income and capital growth and mathematically then can afford to live forever so you don't have that longevity risk. And they've got between $3,000 and $4,000 surplus cash flow per month. And let me see if there's anything else. He's done some rudimentary numbers that suggest that, he will be okay even if they don't do too much more. Now, Mark, I recorded episode 381, and the title of that episode was Why Property Investors Shouldn't Trust the Last 5 Years of Price Data. And I feel like I wrote it for you, or at least for people in situations that you're in. For example, the Queensland or Brisbane property, I should say, it's sort of outskirts of Brisbane, if you like. He purchased that property in 2016 for $500,000. It's worth $830 now. And so he's put down around 4.4 yield, 5.1% growth. That's a 9.5% total return off that asset. I imagine it's since 2016 that quoted return. The question is, would you get just 9.5% from an asset that is 40 kilometres north of Brisbane CBD for the next 20 years? That's the question you need to contemplate, Mark. And sorry, I always hesitate when using names because Mark is a pseudonym and I'm always paranoid that I'm going to call someone by their real name. Anyway, that's the thing that Mark needs to think about, and that anyone that's doing sort of future projections needs to think about, whether they extrapolate, relatively short data across a 20-year period. I mean, I just don't think that's a good return. 9.5%, I'm telling you, that doubles more than, well, actually 9.5% means your property is going to double every 7.5 years. I mean, yeah. And it's 40 kilometres north of Brisbane. So these are the things that you need to really think carefully about. Now, the property in Melbourne, which I can speak more informally about, is in a location that I wouldn't invest in myself. It's in a location. So the problem in Melbourne, I was having this conversation today over lunch with Campbell, in fact, who obviously hosts the podcast every now and again. The problem with Melbourne is, as it's in any city that can kind of spread out, is they don't build infrastructure well enough to accommodate the extra population. And so what happens then is that you end up in a situation with an area that doesn't have a lot of amenity. Then the traffic is terrible. So to get from that area to another part of the city is a nightmare in of itself. And so that really does reduce the livability of a particular location. And that's only going to become more pronounced over the next 20 or so years. And the property that Mark has invested in Melbourne is one of those properties that is in an area that has a lot of kind of homogenous property. And there is vacant land in relatively close proximity as well, which is a challenge. So they're the things that I would be thinking about. So if I sat down and worked on Mark's situation, I would say, okay, these assets are probably going to they're not terrible. They're not like horrible assets, but I don't want to build a strategy assuming we're going to get 6 or 7% compounding capital growth from them. I just don't think we can do that. So then what I would do is I'd model, look, what if we sold the two assets? What if we did the home renos or did an upgrade? What does that look like? That might absorb some of Mark's surplus cash flow of 2,000 to 3,000 a month. And then what if we just replace it with one asset? Mark did mention towards the end of his email to me that, look, if we sold both properties and only bought one asset, if we sold both properties, I could probably only afford one asset, one investment grade asset. It's not a big deal, right? Let's not be too attached about how many property assets we have. It's the quality of the equity in the property that we need to worry about. So, if I've got exposure to a fantastic quality market, but I've only got one exposure, so one investment property, that's okay. I'd rather that, because remember here, what we're thinking about and what I want people to really consider and understand is, if we're developing a strategy, we need to think about risk. What is the path that Mark can take? What are the decisions that Mark can take that give him the highest probability of achieving his goal, which is a perpetual portfolio in 20 years' time? There could be many ways to achieve it, but what is the lowest risk? What's the highest probability strategy that's going to achieve that? Well, if I compared holding these two assets, one in Melbourne and one in Brisbane, versus holding one fantastic investment grade asset, I would say that the investment grade asset has a much higher probability, particularly over a 20-year period, right? It's a long enough period to ensure that there's a high probability we're going to get the growth rate we seek, I should say. Particularly as, more and more property is going to be built in Melbourne and Brisbane, those capital cities are going to get spread further and further and further. And to my mind, unless the government can turn around and build some huge infrastructure so quickly, well, it's not going to happen. To my mind, those investment grade locations will just become more and more desirable, or if there's increased density in those locations, which there's going to be pressure to achieve that, the productive value of the land will become more significant as well. So that's the thing I would focus on. So I think, Mark, in your situation, putting aside doing financial projections, because, we build our own model and we have done over the last sort of 20 odd years. Some nerd could sit down and rebuild the model. Of course, it would take them many hours, weeks, months, years in order to do that. So I don't expect to, on this podcast, talk about, go away and financially model it. But I think I'm better off to speak to the concept and the understanding, because I think that's what I keep talking about in this podcast, is that investment decisions typically are rooted in, to my mind, logic and basic maths. And in this situation, Mark's got a very low level of non-tax deductible debt, so he can certainly afford to take on more. So doing the upgrade, the renovation to his home, or doing some sort of changeover there, buy and sell, that's affordable. And even if it gives rise to a little bit more debt, $500,000 more debt, it's still affordable. The key things he's off to the races in terms of super balances. He just needs to let that accumulate. I don't know about the other sort of small assets, the managed funds, but that's okay. And then the only weakness in his situation is, will he regret in 20 years' time not selling these assets in 2025, 2026 and putting them in a better quality asset? Well, I don't know, because any asset, who knows? Assets can perform differently, and I'm not saying that an investment grade asset will definitely beat in terms of growth every other asset. I think that's silly. Of course it won't. There's going to be some locations, even if they're not investment grade, that will outperform. The thing is, we don't know. and we've got to go with the asset that has the highest probability of generating the best return. And that's where risk and risk and return need to come into sort of play here when developing a strategy. So if I was in Mark's situation, I'd probably sell the 2 investment properties, go and buy one fantastic investment grade asset, and I would try and execute that over the next 2 or 3 years. So I wouldn't necessarily need to rush into it. So if I felt like I would get myself into a position to, maximize borrowing capacity, cash flow, all that sort of stuff, I'd be quite deliberate about it. And then Mark can then spend a little bit of time repaying the home loan, make additional contributions into super, put money in offset account against the investment properties, and that should be enough, I would imagine, to achieve a perpetual portfolio. I know I've prattled on for a while, but I like to sort of unpack these topics a little bit just to share some insights. Thanks so much, Mark. Thanks for your question. I hope the answer's been helpful. Okay, next question is from a listener that wants to remain anonymous, but he shares some lovely feedback about the podcast. I appreciate that. I don't always want to read it out. I don't want to feel like I'm just sitting here patting myself on the back, but I do very much appreciate you sharing your feedback. So the question is that this person has a home loan, about $1 million, and 2 other investment properties with some equity in it. So one investment property is worth $790, with $530 of debt, and the other investment property is worth $775 with $468 worth of debt. So a bit of equity in there. And here's the question. We're considering repaying our primary place of residence first. We heard of a strategy using equity from our investment properties to pay down our home loan. We plan to do it in the future once we build up more equity in our investment properties that we can borrow. Is this a practical strategy? From an ATO and tax perspective, how could this strategy affect our tax deductions? And could it realistically help us become debt-free faster while keeping our investment properties on interest only in the near future? So there's a common, it's not uncommon for people to have this misconception that the asset that secures the loan somehow determines its tax deductibility. It's not true, it's the purpose. So let me give you a really simple example. If I have a home loan just like this listener for $1 million, and let's say I've got an investment property that's worth $2 million and it doesn't have any debt against it, I can't just go and borrow $1 million against the investment property and then use that money to repay my home loan. It's always about the purpose, and the purpose determines its tax deductibility. The security has no difference. What property you use to secure a loan has no impact on deductibility. Names on the loan have very little difference. Who repays the loan also has very little difference. It all comes back to the purpose. So in the example I just gave you, the purpose I used that new loan for was to repay a home loan. So it inherits that purpose, just like when you do a refinance and you refinance an investment loan, it's still an investment loan. You refinance a home loan, it's still a home loan. It retains its original purpose. So you can't do that. The only way that you can accelerate the repayment of non-tax deductible loans is 2 ways. One, sell the properties, pay selling costs, pay capital gains tax, and then what you have left over, of course, you can put against your home loan. So that's one way, although not very palatable or attractive to people. The second way, and I'm not saying you can do this, you need to be really, really careful. The ATO is and has a lot of guidance around whether you can do this and whether it's safe to do this. But the only other way you can do it is to say, instead of paying for negative cash flow that relates to your investment properties. So if I've got an investment property and let's say it's costing me $20,000 a year to hold after tax, instead of me using my cash flow to pay for the $20,000 holding costs and then putting the rest of my income into my home loan, I'll go and borrow the $20,000. And then I'll put the rest then I can put all my income into my home loan and repay it. The challenge with that is that what will happen is that each year your debt against that particular property will increase by $20,000, using the example I just gave you. And if you don't have uniform growth, so if you go into a flat cycle, you might end up in a negative equity position. Like, if you don't get any growth for 5 years, but you borrowed another $100,000, 5 times $20,000, $100,000 to fund the negative cash flow. Don't forget you got interest on interest as well, so it could be even more than that. It's not a good idea. I don't think it's a good idea because what you're doing is, you're borrowing against an asset that won't have uniform returns each year, so uniform capital growth. So there is that risk that you go negative equity. And then secondly, You've got to be careful about it as a strategy from a tax planning perspective because the ATO's released a lot of information about it. So there's no way you can make this $1 million loan magically disappear. There are some other strategies that you can use if you are self-employed or a sole trader like a medical practitioner and so forth. They do have, which I can't talk about here because the ATO doesn't like, you talking about it or me talking about it. They wrote me a letter probably 20 years ago about it. So I'm not going to do that anymore. But, if you get some good tax advice. But apart from that, there's no other way. In fact, did an episode early this year, episode 290. There's only 4 ways to accelerate the repayment of your home. That is, get a lower interest rates, have more cash flow, improve your cash flow position. And that's pretty much it. If you're a medical practitioner or one of those, speak to your tax accountant and make sure you got a plan B, which is the kind of full strategies that I allude to in the title, but that's really the only way to do it. So what this listener's understood is incorrect. It's not going to work, and you just got to be really careful about getting tax advice. As I've said a couple of times on the podcast, get tax advice from someone that has to live with the consequences. So that is your registered tax agent that lodges your tax return. If they give you some advice, and that advice comes back to bite you, they've got to live with those consequences in terms of deal with you as the client and deal with the negative feedback and all those sorts of things. Whereas, taking well-meaning tax advice from a family member or friend or something like that is just too risky. And, I certainly wouldn't advise doing that. Okay, I might leave it there for today. Tomorrow, I'm going to talk about being a value-add property investor, which I think is something that, is a strategy that should be more commonly considered. And particularly if your budget is under $1 million, I think, in most markets, it's a strategy you might want to think about. So until then, bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.